want to welcome in now Simeon Hyman, ProShares Global Investment Strategist, as well as Brian Levitt, Invesco Global Market Strategist. Guys, welcome to you both. Brian, I'll start with you. It looks a little relatively calmer out there, right, as Jared was just saying today. Not just the popular averages, but 10-year Treasury, Brian, we're holding steady here at 4.33. VIX has tumbled, the dollar firmer. What do you make of it?
It feels a little bit like where we were before Liberation Day, where everybody thought we may start to get better outcomes with regards to the trade conflict. So I think as soon as we put a pause in place, the expectation was maybe we've seen the worst of it. And we probably have seen the worst of it in terms of where tariffs go. Of course, tit for tat conflict with China could continue. But that's becoming more of the perception. My concern is the longer this is in place, the longer the uncertainty persists. Obviously, the bigger the hit to sentiment, the bigger the hit to investment. I don't think it's a market that's priced for recession. So that's the challenge. Hopefully, we will get better news, but we're all a bit on the whims of the White House right now more than we typically are.
Simeon, let me ask you, I want to get your take on the earnings picture as well, because we got more big banks reporting this morning at Bank of America, Citi. I mean, both those names are higher in today's trade. We'll talk to an analyst later about those names. But kind of just bigger picture, Simeon, I'm just curious what you've made of the earnings season so far, lessons learned, obviously with big tech still on deck.
Well, first let's put it in context. And the context I like is, let's skip over the great financial crisis because there's so many other moving parts. Let's go back to the turn of the century when we had a downturn that was after a long period of tech outperformance. Here's a couple of points of comparison. We were at 30 PE then. We're at a 22 PE now. But 10-year bond was 6.5 then. So apples to apples, it's almost like 13 versus 15, 16. So valuation's more attractive. And very specific to the earnings point, take the tech sector. The price to book is the same as it was 25 years ago, but the PE's cut in half. That means that the tech sector is generating double the amount of earnings per dollar of book value. So we're coming for some pretty strong fundamentals. And earnings season, we know it's rearview mirror, but it's coming in okay, not bad at all.
Is that your take, Brian, as well, okay?
Yeah, it's certainly coming in okay. I mean, we'll have to see. We want to see what the guidance looks like, and I think a lot of these CEOs and CFOs are a little bit challenged on that.
Are you surprised on that point, though, that big banks, they weren't like pulling guidance? There was fear that we would hear more CEOs just say, or CFOs saying, listen, I'm pulling guidance. I can't give you a forecast.
Yeah, I'm somewhat surprised, but I suppose I mean, you have to remember the economic setup was quite good. Coming into the year. The U.S. economy was in a good place, inflation was stable, Europe was coming on, so we were in a better place. A lot of animal spirits, still looking ahead to what deregulation could mean, to what tax cuts could mean, but yeah, we're in a bit of a challenge here. I am a little bit surprised that more didn't pull, but more more on the industrial side, more on the manufacturing side. I think the challenges are going to persist.
I want to get the same question to you about earnings. When you think about corporate profit growth, Brian, in 2025, what does it look like to you?
Well, I think it moderates. I mean, I don't think that we're going into negative, a negative growth area, but it's certainly going to moderate. I mean, look, the reality about tariffs is you may say there's a rationale for it, but somebody has to pay for it, right? So it's either going to be a hit to corporate profitability, or it's going to be passed on to the consumer, or in a worst case scenario, both. So we have to imagine that. I mean, leading indicators are pointing towards slower growth. It's going to result in slower corporate profitability. And, again, the market is assessing what that hit is. Are we heading into a recession? We certainly hope not, but policy mistakes, if left in place long enough, can get you there.
Against that backdrop, Brian, I'm curious, in the equity market, what sectors look attractive to you? And have you kind of shifted given all the tariff and policy uncertainty?
I would still be defensive here. In an environment where leading indicators are still...
And does that mean staples, healthcare?
Yeah, I mean, I would think more, if I think about it from the factor level, I would think more higher quality businesses. I'd also look quality and adding some value into the portfolio
When you say quality, Brian, how do you screen for quality? What does that mean to you?
Well, I'm thinking about cash flow generators, companies that don't have impaired balance sheets, that don't have to roll debt in the near term. I mean, I think it's less about sectors right now and more about what type of factors we want to be exposed to. And so, what I think is important for investors, coming into the year, the hope was we're going to have a broader market, right? And the idea of a broader market was better nominal growth in the US and around the world. And as a result of that, a little bit more value, a little bit more mid-cap, a little bit more Europe. And the reality is that worked, but not the way everybody anticipated it would work. It worked with some of the highest concentration names, highest valuation names coming down more. What's nice about that trade and why I think it makes sense in a portfolio is if the economy rolls over more, you're coming at it from a lower valuation perspective. If we get the recovery, those are the types of markets that tend to outperform in a recovery.
And Simeon, I think last time we spoke, I asked you where you saw opportunity. I think you were sticking with those sort of dividend growth strategies.
Couldn't agree more with the quality point. And for us, an easy way to capture quality are consistent dividend growers. The S&P 500 Dividend Aristocrats, it's our ETF, NOBL, Noble. These are companies that have grown their dividends for 25 straight years. That means they grew their dividends in the great financial crisis, if that's just one proof point for you. And it fits the sector composition. You've got more staples, less technology. They've been underperforming because of the tech run for the last couple of years, and they've got all the things that you mentioned, strong balance sheets, cash flow generation. So that's certainly one way to capture the quality idea.
That's what you like, Simeon. I'm curious what you would avoid here. What doesn't look as attractive?
Well, look, there's a simple one. Energy. At some point, you've got to do the counter-cyclical. You buy it when oil is dirt cheap, but we're still on the cusp of a falling bit of demand here. So that's an easy one. And by the way, look, it's only 3 or 4% of the S&P 500. So it's not like if you're nervous about technology, taking it to zero is too extreme. But you could take energy to zero, it's 3 or 4%. And if you're right, you're going to outperform the S&P by 100 bips. And if you're wrong, you're going to underperform. So it's a prudent thing to avoid.
We went through this whole interview, Brian. I didn't even ask your outlook on the Fed. What do you think Jay Powell does this year?
I think the Federal Reserve is going to bring rates down gradually. I think the most important thing is I think they're ready to respond if there's disruption in the bond market. And clearly the administration seemed willing to respond. And that goes back to the old Carville line about I want to come back as the bond market so I can intimidate everyone.
Right.
I mean, we certainly, I personally would rather come back as Tom Brady or Mick Jagger, but so be it. So we've seen the response. I think the Federal Reserve is going to look through, we're going to have inflation in the near term. I think they're going to look through the price shock if growth deteriorates and if there's disruption in the bond market. The reason for that, I mean, it's the reason why they've always used core when looking at inflation data, because they don't want to respond to price shocks. They want to make a determination on what long-term inflation expectations are going to be. Long-term inflation expectations, at least if you look in the bond market, very contained, which gives them the ability to move as growth slows. Now, do they solve all of our problems for us this time? I mean, they probably give a market boost, but I don't know they solve our problems. We really need to see the clarity come on the trade side.
What do you make of that call, Simeon?
It was very comforting to see some stability on the long end of the curve for as much as any other reason, because what this does is it allows us to continue to view bonds, longer duration bonds, as being in a position to diversify equity risk. We haven't had that opportunity in a generation because quantitative easing brought yields down so low that in 2022, bonds couldn't bail out stocks. From 4.5% 10-year, the idea is if we have a recession, then we'll have 2.5%, 3% on the 10-year, and you make 10% on the ag. And it looks like that will hold for now. Because remember, QE is back in the back pocket of Powell. They can do it again and bring those rates down even below 2.5% or 3% if needed to stabilize the economy.
Guys, that was a great discussion, a great way to kick off the show. Thanks to you both.
Pleasure. Thank you.
Simeon, you're going to stick around. Brian, thanks so much. Appreciate it.